Good morning. These are the things that matter most in the U.S. market today. The AI trade is no longer moving as one block. Long bonds are pushing back after the Federal Reserve held rates steady. Oil risk is keeping inflation sensitivity alive. And one underappreciated story is that healthcare may be turning from a forgotten sector into a defensive quality test. The central question for private investors is simple. Can Wall Street keep rewarding growth if the market now demands cash flow, rates discipline, and proof by company? Start with AI and megacap technology. U.S. futures were steadier as Microsoft helped offset concerns after the Fed, and reports showed Microsoft rising on a stronger revenue outlook and maintained capital spending guidance. But the same AI spending debate is not helping every name equally. Meta is being judged more harshly because investors are focusing on how AI spending affects free cash flow, while Nvidia rose after the Microsoft and Meta earnings read-through. The market is not asking whether AI matters. It is asking whether the next dollar of spending creates revenue, margins, and durable demand. The cleaner side is companies that can connect AI investment to cloud growth, paid products, and operating leverage. Pressure sits with high multiple names where the story requires perfect execution and rising capital expenditure without enough cash flow proof. For private investors, the practical takeaway is this. Microsoft can support the AI tape, but it cannot validate every AI stock by itself. Second, rates are back in the conversation. The Federal Reserve held interest rates steady, but the more important market reaction is in longer bonds. Reuters framed the morning as a long bond scare, and investors are waiting on GDP, core PCE, and jobless claims data. That matters because a market can absorb strong earnings more easily when yields are calm. If long-term yields rise while growth stocks are expensive, the valuation hurdle becomes much higher. Potential beneficiaries are banks, insurers, and cash-rich companies if the rate move reflects resilient growth rather than inflation stress. Pressure is more visible in long-duration software, speculative growth, home builders, and highly leveraged companies if yields rise for the wrong reason. For private investors, the useful filter is to separate a healthy growth signal from a valuation headwind. The same rate move can help one basket and hurt another. Third, oil remains a market-wide tax test. Google News and market reports highlighted Brent around $90, low U.S. crude stockpiles, and renewed Iran-linked tension. For Wall Street, that is not just an energy headline. Oil can lift Exxon, Chevron, and energy services while squeezing airlines, transports, consumer margins, and inflation expectations. It also matters because the Fed is already cautious. A fresh oil shock makes the disinflation path harder to trust. Winners are energy producers, selected service companies, and firms with pricing power. Pressure sits with airlines, transport companies, retailers, and rate-sensitive growth if higher fuel costs feed inflation anxiety. In plain English, the takeaway is this. Oil can look bullish for part of the index while quietly tightening conditions for the rest of it. The underappreciated story is healthcare. MarketWatch reported that investors are overlooking healthcare stocks and cited J.P. Morgan's view that selected names deserve attention. That matters because after a violent move in high-flying technology shares, the market may start asking where earnings are less crowded and less dependent on perfect AI execution. Healthcare is not one basket. Eli Lilly, UnitedHealth, Johnson and Johnson, Pfizer, and selected medtech names respond to different drivers: drug growth, reimbursement, utilization, balance sheet quality, and defensive earnings. The cleaner side is companies with visible demand, pricing power, strong balance sheets, and product cycles that do not depend on the AI capex race. Pressure sits with names facing reimbursement risk, patent cliffs, weak pipelines, or political pricing pressure. For private investors, the takeaway is that healthcare can become useful again if the market wants earnings durability, but the confirmation has to come stock by stock. Here is the stock-led watch list. Microsoft, Meta, Nvidia, and Amazon. Does AI spending get rewarded only where the revenue path is already visible? Tesla, Apple, and high-multiple software. Does long bond pressure cap the growth rebound? Exxon, Chevron, United, and Delta. Does oil lead the tape, or does fuel pressure become the broader market tax? Eli Lilly, UnitedHealth, Johnson and Johnson, and Pfizer. Does healthcare start to act like quality defense, or stay ignored? Market bias, selective, rate-sensitive, and proof-driven. The market can still reward winners, but it is harder to trust the broad theme when bonds, oil, and cash flow scrutiny are all active at once. The mistake to avoid is treating every rebound in popular stocks as a clean risk-on signal. Today's better filter is confirmation. Which stocks can prove the story in earnings, cash flow, and margins, and which ones only share the label? That is the U.S. Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.